So I'm honored to have with us Redfearn, Director of the Division of Trading Markets at the SEC. I will dispense with any other introductions because we have a lot to get into today with a lot of developments even over the past week. So before we do that, I guess, Brett, I'll give you a break on discussing transaction fee pilot in a little bit. But COVID-19 operation of the markets, we talked a little bit about it earlier today. Hester talked about it this morning as far as kind of the SEC's experience and discussions with market participants. But maybe to touch on a couple things. There's a number of regulatory measures that's been in place, not only in the US that the SEC has had, but globally. Short selling restrictions just came up on the last panel around ETFs and some of the issues that's caused for them. So from your perspective, how have circuit breakers, other regulatory measures worked from your standpoint? What have you guys learned from this, and maybe any tweaks going forward?
So thank you, Ari, and thank you for having me. I'm glad that you all could join us today. This is an important topic and one that we've spent an awful lot of time on. I think, as most people know by now, our markets functioned extremely well despite the record volumes, the record message traffic, and not to mention the fact how many people were dealing with all of this from their homes or from a remote location and so on. Impressive how few glitches we saw. I think that speaks very highly of the infrastructure investment that's been made and Reg SCI and the rules there about redundancy and resiliency. We saw a few isolated instances in some areas of problems. I think you are aware of some retail brokers that had some issues, and on the options markets, there was one point in time where the message traffic was so astronomical, they had some issues with sequence numbers, and that could have been problematic, but that turned out to not be such a big deal. So yeah, markets function extremely well. We've also tracked our regulatory mechanisms, as you mentioned, Ari. So we had the ability to look at market-wide circuit breakers for the first time, and then the second time, and then the third time, and the fourth time. So we saw 4 different cases of this, most of which happened right around the open. And so when you think about that, and you think about the fact that we had triggers that went off at 9:34, 9:35, one of them went off right at 9:30, like seconds after the open, and then there was one in the afternoon. And so, look, for the most part, it went well, right? I mean, people had time to stop, to think. We had 15 minutes. The order books filled back up. When the circuit breakers ended, the markets reopened in an orderly way. We didn't see a big dislocation. I was worried about potentially, could you have a lot of sellers and not a lot of buyers in the book that would potentially dislocate after the halt? That didn't happen, so we were pleased with that. But that being said, there have been questions raised about, well, if people had, all night to think about it, because you saw the futures were already banded down at 5%, certainly on the night before March 9th, the first one, do you really need another 15 minutes right after the open to think it through? So there is a task force that's been formed, Ari, that's looking at those questions, but I think for the most part, what we're hearing is that, if it ain't broke, don't fix it. For the most part, it worked. And you can't solve, as you know, with these regulatory mechanisms, you can't solve for every possible scenario, right? So this time, it was generally around the open, but next time, could there be an event where you're responding to, to something that happens intraday or midday and you don't have that? So, so those are all things that we're thinking about. And obviously, Ari, we're looking very closely also at limit up, limit down, the short sale rules and other regulatory mechanisms as well. But for the most part, we don't have any burning, issues that we've come away with and say, right now we absolutely have to fix this aspect of the regulatory infrastructure because it didn't work well. We have things that we might tweak. We have things that we're still going to study, but fortunately, it worked very well.
So another issue has been around folks working remotely, working from home. I know trading markets has been a lot of discussions with folks around this, investment management, even the commissioner level with market participants. Any thoughts around that? I know people are getting used to working from home, but any regulatory issues that have come up over the last few months?
So, look, I mean, yes, we have been looking very closely at how that's worked. Again, in many respects, it's gone remarkably well. I think we're all pleased at, how seamlessly things seem to have transitioned to the home environment. I know here at the SEC, quite frankly, I'm still, regularly pleased and in some respects surprised at how well, we've just transitioned to this type of environment. We have our meetings, we have a lot of things that are getting done. We're still having engagement with other regulators. We're still having engagement with market participants. Things are staying on schedule. We're seeing high levels of productivity. So at the commission here, I think it's working very well. Our workflow, though, I think is probably less, in need of that sort of, togetherness that you might need in some other places. And that includes on trading floors. With respect to banks, there's been a lot of areas where we've had to, banks and brokers, where we've had to look at relief to give. There's a whole website on the SEC, a COVID website that you can check out that has all of the areas of relief that we've given. We've worked very closely with FINRA on relief that they've given, and that includes, related to fingerprinting, related to physical certificates, related to supervision, right? So there is a whole set of issues that we've had to deal with, but for the most part, it's been working very well. And I would say now, part of the thinking now is as markets are starting to, as people are starting to think about, what happens when we get back to, let's call it the new normal, how's it going to work? And what are the things that we just learned that we actually want to keep and we want to continue doing? So I know that, it's unclear to me whether or not things will ever be exactly the same. I think we will see more teleworking. I think we will see, more remote activity. And I think that for all the areas where we've had to provide short-term exceptions to accommodate certain things, there's going to be another set of things that come up where we say, maybe we need more longer-term relief to be able to allow for, less paper or less physical presence or fewer wet signatures or, you name it, going forward, because that may be the way that the world operates, on a more permanent basis in some areas.
Great. So want to move on to kind of Reg NMS 2.0, as we're dubbing it. A number of initiatives that the SEC has proposed around long-standing issues for the buy side, as you know, addressing conflicts of interest, addressing transparency, a lot of the issues that you've been looking at, not only at the SEC, but even thinking about before you joined the SEC staff. One of the things is around the market data issues, not only market data itself, costs, trading costs, but also around how the folks listening on this, the buy side, can even interact and comment on some of these proposals. So maybe let's just tick it off one at a time. I mean, one of these initiatives that hasn't gotten a lot of attention lately is the proposed rule to require amendment to an NMS plan that would establish a change or a fee be subject to the quote unquote standard procedure. So not letting it go through and eliminating the current exception to be effective immediately upon filing. Again, I think that's been a little lost with everything else going on, but can you discuss that proposal, where it stands and where it is going forward?
Yeah, sure. So, look, we're looking at a lot of different things, and I'm trying to think. I guess I didn't start with my disclaimer. I'm going to say it now. The views that you all hear today are mine and mine alone, and not those of the commission or any of the commissioners or any of the staff or anybody else. So let's just make sure we get that on the table too. So going back to this, look, in October of last year, the commission proposed to delete a rule under the Exchange Act. It's Rule 608B3, and to rescind the effective upon filing procedure for NMS plan fee amendments. That basically means for NMS plan fees, they would be immediately effective on filing. And when they're immediately effective on filing, people think differently about engaging in the comment and review process of a fee. It is conceivable that a fee filing like that could be abrogated, but I think the suggestion here was that there's a lot of money on the table here for NMS plans. You're talking about in the zone of $500 million a year. And there's a lot of concern about some of these fees as well. And so this rule basically, simply as proposed, would suggest that the standard procedure, as you mentioned, would provide an opportunity for public comment and commission approval before an amendment can become effective, right? And so we got 14 comments, I think, on that proposal. We're evaluating the comments now. We appreciate the engagement with this one, as with everything else. But I think the idea here, Ari, is that, you know, for something of this import, you know, the immediately effective on filing wasn't necessarily helpful, and a notice and comment period seems meaningful. So, so we're looking hard at this one now.
Right. SIP governance, the next part of kind of Reg NMS 2.0. We talked a lot about it in earlier panels today. Hester spoke about it a little bit earlier as well. So without, I guess, you know, spending time on some of the background on it, what's the significance, again, for this buy-side audience of the SIP governance proposal? You know, next steps, obviously, I think the folks on this call will get another bite at the apple, so to speak, maybe to comment even on their thoughts on that.
So, right, and so the SIP governance issue has been one that's been percolating around for a while. I think folks understand that, you know, again, you know, this is our national market system, and this is the securities information processors that provide data out to, you know, I mean, the numbers are astronomical in terms of retail investors, and then there's also, you know, how potentially brokers or institutions also use this information. And as you know, Ari, the backdrop to this is that, you know, the NMS plans as they were initially conceived was, you know, back in the late 70s. At the time, the exchanges were, you know, the exchanges of the SROs were not-for-profit mutualized entities. And they, you know, and in light of that, it was a little bit of a different dynamic. And what's changed is over those, you know, over those several years, we now have a world where the business models changed, they expanded, they're for-profit, they're publicly traded, they have an obligation to maximize shareholder value. And in the course of all of that, as everybody knows, they're selling separate data feeds, they're selling proprietary data feeds that are faster and have a lot more content, and they're selling proprietary data feeds that significantly are less expensive and have less content that are sold more to a retail audience. But since you have a number of entities that are around the table that are, you know, pretty much solely governing these plans and selling competing products, we saw a conflict of interest there that really needed to be addressed. And we, you know, and there's a view that that conflict of interest may be part of the reason why the SIP evolution has significantly lagged the prop feed. So everybody knows that SIP data is slower and it has less content, and it essentially also lacks competitive forces there because they're exclusive monopolistic processors. And so the idea in the governance order is, right, this isn't focused so much directly on the infrastructure. That will come, you know, that's more in the next release. This is saying, let's address those issues. The world has changed. We think that it makes sense for there to be a broader amount of participation around the table. And so we've suggested, you know, an institutional broker, a retail broker, a buy-side participant, right? So this is why it's very relevant to, I think, also to asset managers. A vendor, we've included an issuer, somebody who represents the interest of retail investors, right? We want a broader, diverse view around the table, and think that that's important in terms of how we think about the evolution of our national market system plans. Keep in mind with that governance, the SROs would still have a majority vote, right? The SROs still have special obligations under the plans, and so they would still have a majority vote amongst themselves. But we would also sort of deal with the issue that since we now have all of these exchange groups, you know, that, you know, there's these three major exchange groups that have 4 or 5 different SROs. And so we're also sort of level setting that a little bit, saying that, you know, there could only be a maximum of 2 votes for any group, such that you don't have such a dominant influence by these groups as well. And so that you again mirror out that. So the idea is to, you know, sort of recognize that the world has changed, to try to address some of the conflicts that are out there, to deal with also, as you know, there's some confidentiality issues that are being addressed, and to try to create a better governance structure for the way in which this can evolve and move forward.
Right. You know, we can probably spend a whole panel on, obviously, market data infrastructure proposal, so we won't. We got a couple minutes to summarized 500 and something pages. But look, I think from the buy side perspective, from the folks listening, it will expand the core data. It'll introduce competition into the marketplace, which is, again, things that the folks on this conference have been asking of the SEC for some time. Again, maybe you can talk a little bit about some of the highlights or anything that you want to highlight from that significance to the buy side. But also, we talked a little bit earlier on some panels. I'm not sure, Brett, you were able to listen, but around OPR and, the buy side, as you know, Brett, asked for OPR back in the day. I think some of those views may have changed, but maybe you can talk about OPR, how it plays into BestX, and thoughts from the SEC around that.
Right. So, Ari, on the infrastructure release, again, we understand that that the core data, the NMS plan data, significantly lags what's happening in the proprietary market in very important ways, right? And the first one is content, right? The level of content is just not there, and it really hasn't evolved, right? It hasn't evolved to keep up with the way our markets evolve. We talk in the release about how when we went to decimals, the amount of liquidity that was displayed at the inside actually shrunk considerably. So I actually think back in 2001, they probably should have considered showing more levels of depth than they ultimately did, because you really took away depth with that particular change, and that was never remedied. So there's an idea here that market participants with penny-wide quotes and a lot of these things really should see more depth. That with the number of high-priced stocks that we have, right, and you see the FANG stocks and a number of securities trading over $100, $500, $1,000, right? There's a lot of liquidity that's in the prop feeds that is within that 100-share round lot, right? And so the idea here is, more of that should be displayed. More people should see that liquidity and be able to access it. And institutions, there'll be cases when it's relevant and cases when maybe it's less relevant. But for retail, right, if there's a 50-share bid or offer in, an Alphabet or an Apple, like that's very meaningful liquidity, and that's something that they're not only going to want to access, but they're going to want to think about when they think about their best execution. So we thought that we really did need to expand the content. That was the first thing. In so doing, we did have the question about OPR. We had to decide this question about protecting that sort of new round lot, that new NBBO, and without getting into the details, people will understand that we proposed sort of narrowing the size or reducing the size of the number of shares that would be required to create the NBBO, right? And then the question was, do you protect it? And the reason why the proposal doesn't have a protected area was that, and this is a buy-side audience predominantly, was that, first of all, it's the OPR issue, as we all know, is definitely controversial. And so I think a part of our thought initially was leave it alone. It's 100 shares today is the protected quote. We'll leave it at 100 shares, right? The liquidity that's inside of 100 shares, well, most of the institutional brokers are currently taking in direct feeds, and they're seeing that odd lot order book, if you will, that odd lot liquidity, and they're making best execution decisions today about what to do around that. So this proposal doesn't change that. If you see 10 shares of a $100 stock or, over one share of a $1,000 stock, you have to make a decision about when is it in your interest or when is it best execution to sort of take out and remove that liquidity, and when is it not? And so we didn't want to, be so prescriptive as to say that you have to always do that, because there are plenty of scenarios that, you can think about where it may be that if there's, 10 shares offered at a nickel and 10,000 shares offered at 7 cents, that somebody might say, you know what, I think I'm going to take the 10,000 shares at 7 cents first and then take the 10 shares at a nickel, because there are going to be measurable cases when if you do it the reverse order, that 10,000 shares might not be there anymore. So our view was that's a best execution decision. People should be able to figure out how they're doing it, and they should be actually doing that today, presumably, because they're already looking at that information. So the protection issue was one where we wanted to leave it alone at 100 shares. We want to provide flexibility with best execution. But for retail investors, we wanted it to be essentially included in the way we think about retail best execution, so that the retail investor can still benefit from, from the execution quality. That's a little bit of a different metric as you think about best execution for retail.
Yeah, so I'm sure we've gotten through some or a good majority of the comment letters came in. Obviously, the focus has been around NDVO, PBVO, protection or not, around round lots. Anything that stuck out to you in the comment letters, and I'm not sure you can answer this, but any initial thoughts on some of the recommendations in the letter and maybe tweaking down the road?
So look, first, let me just thank everybody who took the time to send us letters. It's not your day job, and it can be time consuming. Ari, as you know, I know you get involved in these. So thank you for that.
Job, actually. So yeah, it's my day job.
There you go. So it is your day job. It's good for not for everybody. So thank you for that. Look, we have a lot there, and we're going through them. I had a meeting earlier today where we were going over the comment file, and we were asking questions about, how do we think about, how we move forward in light of all of those comments. And there were a number of commenters who suggested that the new round lots should be protected. And, and there were people also who suggested different tiers for the round lots, right? Some said start at 500. Some said start at 50. Some said start at 100, right? And so we need to, we need to look at that. We need to look at the data that we're given, because we need to make empirically driven decisions. It's got to be, it's got to be database, data driven, and we've got DIRA involved. So we're thinking through all those issues, and we're going to have to think long and hard about, whether or not it's better to protect, the new round lots, if that's what people think. It does have other implications potentially, right? So once you talk about order protection, we had 5 levels of depth past the protected quote. So, you have to think about, does that change? What are the 5 levels that you see afterwards? And if it's 5 levels past one share at $1,000, and that's all, are you actually taking away some of the liquidity that exists beyond that, right? We don't want to have a scenario where there's less liquidity. So we have to think about that and whether or not that affects the way that we also think about what is the appropriate round lot size, right? Maybe if you protect it and you're only showing 5 levels past that, then, maybe it needs to be bigger, more shares at the round lot size, because you don't want to lose too much liquidity on the flip side. So there's a lot of questions that come with that. Order protection affects, locked and cross markets, and how we think about other things as well. So we're really in the weeds on all those comments right now, Ari, and trying to find the best path forward.
And for folks listening, again, it's predominantly buy side, as you mentioned. The comment period is obviously over, but the buy side typically doesn't comment in as much as those on the sell side. I assume you guys are still taking comments in and looking for other viewpoints, especially from the buy side.
Yeah, it's great. It's great. The buy side carries a lot of weight here, and we know that you guys are representing a lot of customers, a lot of retail investors out there. So we do want to hear from you. We don't turn away comment letters. There is a method to the madness. The reason we put in a deadline is because we really do need to get comments and that goes into our thinking, and late significant comment letters can challenge that process, because we are on a schedule and we do calendar all this stuff out, and we need to, stick to our project plans. So this, if anybody is thinking about commenting and hasn't yet, I would encourage you to go ahead and do so, but to do it quickly. Don't let any grass grow under your feet on this one, because we need to hear from you. If you're going to do it, especially if it's going to be different from what we've seen, we'd rather hear from you sooner rather than later. So, but yeah, we're still going through all of that, Ari.
Okay, great. So transition over to some issues around 606. So we're going to have a panel later on, I think right after this, around 606 and TCA and BestX and things like that. Obviously that's been something that the buy side has pushed to get more transparency, deal with conflicts of interest, potential real, whatever they may be. Can you provide an update on 606 implementation, but more importantly, maybe a chance to talk to this audience, how should they be using this? Why should they be using this? And maybe stress to them the importance of kind of this information that you guys took a long time to implement.
Right. So thanks for that question, right? And look, this falls into the vein of transparency, right? We believe in transparency. We think that it helps. The first two big market structure rules that I tried to drive over the line here was this one, so that more broker dealers would be providing information out to all of their buy side clients. Not just the top buy-side clients, but all of the buy-side clients, from big to small. They would have the ability to request information, and that it would be consistent in apples-to-apples comparisons across brokers. I mean, everybody, I know that certainly the larger asset managers are getting a lot of data, but people may do things a little bit differently, and there may be some things they're not getting. Right. So in this data, for example, there is, it's not just executed routes, but it's also where you routing and you didn't get executed. So people will get to see a lot more information about those sort of where, all the routes that were made where they didn't get filled, and what is the ratio of, routes to actual executions, and how does that vary by firms? And some might provide that, but some might not. It might not all be in the exact same format. So the self-routing broker dealers, right? So the broker dealers who sort of handle and route their own customer orders using their own system. Data collection for that began January 1st, and the first report covering self-routing activities in January was required to be made available to customers upon request as of February 25th. So that information is out there. For broker dealers that outsource their routing activities, so we sort of think of white labeling brokers, that was more complicated. They have to get that information in, and they have to aggregate from potentially different white labeling brokers that they use. So data collection on that began June 1st, and the first report covering June is required to be made available by July 29th for customer requests that are made on or before July 17th. Those are just the details, but it's coming. By the end of by July, you can start requesting this information. That's gonna be available. And Ari, maybe afterwards we can talk a little bit more about what we've done on the retail side. But look, a lot of work went into this. I highly encourage folks to take a look at it, to look at these routing, methodologies that people are using. There had been a lot of discussion in the market about, potential conflicts in routing. Mentioning the transaction fee pilot, which it looks like we're not going to be seeing anything in that area for any time soon. So you still have the rebate dynamic that is out there, and I think it's worthwhile to look at the data and look at the routing decisions that are being made, and to try to learn about what's being done and why. And this data should provide a lot more information that you'll be able to utilize that will help you to better understand some of those routing practices that are happening for your orders. So go ahead and make sure you're getting that.
Excellent. Well, we have a few minutes left. You brought up transaction fee pilot, so I'm going to turn to that. So obviously on Tuesday, U.S. Court of Appeals, D.C. Circuit, weighed in on the transaction fee pilot, found that the SEC, quote unquote, exceeded its authority, and that's probably some of the nicer comments they made in the opinion around the transaction fee pilot. So to the extent maybe you can talk about, and if there's an answer to this, anywhere the SEC goes from this, what's the next steps? I think Hester said you were going to answer all those questions later on too. So that's you.
Yeah, so I'll say this, right? So the court held that the commission acted without delegated authority from Congress when it adopted a general pilot to gather data. So the way that when you look at all of this that's in there, a determination was made to not articulate a problem, but to say that we wanted data so that we could better understand, whether there is a problem, and if so, what to do about it, right? And so and I'm going to put it in layman's terms, but I think the general gist of it was, you shouldn't do rulemaking to collect data to see if there's a problem. You should use data, determine there's a problem, and then do rulemaking to fix the problem, right? And that may be an oversimplification, but that's kind of how I look at it. Keep in mind that while the TFP is not proceeding, the Commission has to continue to work to ensure that exchanges provide for the equitable allocation of reasonable fees that are not designed to permit unfair competition. And, in so doing, we're going to seek data analysis on exchange fees, including fee and rebate pricing models, fee tiering, connectivity, market data fees, all these different things that we have to do to review fees. So it suggests to me that, some additional analysis is warranted and maybe forthcoming, and to the extent that that analysis points more clearly to a problem that needs to be addressed, and that problem would be addressed in later rulemaking.
Great. Maybe we're sort of out of time. I want to ask you one more question that you kind of brought up around, again, other types of scrutinizing fee filings and things like that. This probably hasn't gotten a lot of attention in the last week with everything else going on, but the SEC last Friday, I guess, maybe, issued a request for additional information and comment around the NYSE national fee filing. And it had some interesting, if you go through it, obviously some interesting requests for comment, and it gets to a lot at the heart of some of the things that have been touched on around market data fees. Can you maybe talk about that? I don't know if it ended up in the federal in the last day or two, but there's probably the comment period might have just kicked in for the next 3 weeks. Any thoughts on that, or what you would love to hear from the public?
Yeah, so I mean, look, exchange fees, and in particular fees over data and connectivity, has been an area of some focus for us, and for a few reasons, right? Certainly, we've had a lot of input from the public suggesting at times that they don't think that the fees are fair and reasonable. We've had a number of comments that have been made that have suggested that there is not adequate competitive forces at play in the marketplace, and that this has impacted an escalation of fees. So those issues are a backdrop to a situation where, suffice it to say that, these are fees that are immediately, so for proprietary trading fees, these are fees that are immediately effective upon filing, right? The process of getting comment usually includes like after they go into effect, and the commission has the ability to issue an OIP, which is where we can institute proceedings, and that's typically done at the staff level, or we can also do sort of a request for additional comment, and that's what's happening here. In the backdrop to this, there was a decision made by the court, we call it the Susquehanna Decision, and the Susquehanna Decision, without getting into the details, basically said that you can't just rely on a statement that these fees are fair and reasonable, or these fees are, not discriminatory, or these fees are based upon competition. When those statements are made, they need to be demonstrated, right? You can't just, the term was unquestioning reliance. Can't do that. So that means that when these things come in and they claim competition, or in many cases, we're starting to see these platform theory arguments that are being made around competition, we need information, data, and support for those claims. And so we had put out, the staff had put out some fee guidance where we tried to suggest at a staff level how we thought that might be able to be done. And I think that we're generally still concerned that the level of support and substantiation behind some of these fee filings isn't there. So last Friday, keep in mind, this was, I think, probably one of the most, if not the most detailed requests for information on a fee filing. And it came out at the commission level, not at the staff level. So I think it's important to note that this was a commission request for information, not a staff request for information. And it really just goes through a lot of the arguments that was made and asks for detailed information that will support those arguments that are in there, because to do our jobs, we need that information to be able to make those determinations. We can't have unquestioning reliance on the statements that are otherwise being made.
Right. We're over, but is there anything else that we haven't touched on that you might want to highlight in a minute or two?
There's a lot going on here. I can tell you that the commission and the staff and the team in trading and markets has been outstanding throughout this period of time, including a lot of the folks in trading and markets. It's just amazing to me how hard they're working. But I just wanted to just say to everybody, again, we appreciate your input, we appreciate your feedback. We're open for meetings, so don't worry if you can't come down here to DC. It's actually easier in some respects to share your views with us because we can set up a Zoom or a WebEx or whatever it is. So we want to hear from you. And please continue to engage with us. It takes your feedback for us to get things right. And aside from that, I just hope that everybody is safe and healthy and washing their hands a lot during this incredibly unusual period of time.
Well, thanks, Brett. And as you probably, I can tell you the theme of the panels this morning has been how well the markets have operated. So I know a lot of that goes to the hard work of the staff. So thank you, Brett, and I'll turn it back over to the folks at IAA.